Okay, today we're digging into an analysis on Robinhood markets, which calls it the best stock of 2025 after its huge 200% run up.
A massive financial transformation. So let's just get right into how we can sharpen that thesis.
First up, let's talk about the angle, specifically on justifying that premium valuation. The piece needs a much stronger defense for Robinhood's PE, which is sitting around 45x, right?
Exactly. That's the number one bear argument you're going to face. And the weakness here, I think, is that the analysis notes the 45x multiple, but then it sort of just moves on.
It jumps straight to the price target, that $150, $160 range.
Yeah, and it doesn't really connect the dots on why that high multiple is fundamentally warranted by the incredible financial velocity. We're talking revenue doubling, that huge 43% net margin. The pieces are there, they're just not linked.
So the suggestion isn't to just mention the valuation as a risk. It's to actually reframe the entire argument around it.
You're saying argue that the 45x PE isn't something to be scared of.
It's necessary. Or, maybe even cheap when you start factoring in that forward-looking growth.
And you could make that really concrete. For example, you could explicitly line up that 45x PE against the rising FY 2026 EPS estimates of, around $2.27? Show the math for how that aggressive growth makes the multiple look temporary. Or you could quantify how a robust, 43% net margin demands a premium over legacy brokers.
You make the valuation a feature, not a disclaimer. I like that.
Exactly.
Okay, so that anchors the financials. But the second piece here is about the story, the narrative. Let's look at the idea of contextualizing the comeback story.
Right. Because calling it the best comeback story is a fantastic hook, but you really have to earn that title.
And the weakness right now is that we're almost entirely focused on the 2025 success. The 200% return, the S&P 500 inclusion, the market cap, it's all the after picture.
Totally. And if you don't define the before, the low point, the story loses so much of its narrative power, doesn't it? A comeback from what, exactly?
So we suggest introducing a brief, but really high-impact, contextual comparison, something that defines the sheer magnitude of the turnaround.
You have to show how deep the valley was to make the mountain peak feel impressive.
So concretely, what does that look like? Maybe you drop in a key stock metric from early 2024, the lowest market cap maybe?
You could. That contrast would be powerful. Or I think you could get a little more strategic with it.
Go on.
Explicitly frame that three-pillar strategy, the gold memberships, the futures, the crypto volume, as the direct fix for their old revenue problems.
For the over-reliance on payment for order flow that burned them before?
Precisely. That way, the success doesn't just feel like luck or market timing. It feels strategic. It feels earned.
Okay, so to sum it all up, this is a really compelling thesis. To take it from strong to, a must-read, it really comes down to two moves.
1. You have to flip that valuation argument. Turn that 45x PE from a risk into a core feature of the bull case by tying it to forward growth.
And 2, you have to give us the roots of the turnaround. Define that low point so the comeback feels truly complete and earned.
You nail those two things, and this analysis goes from being highly persuasive to absolutely undeniable.
We genuinely look forward to seeing the revised version. Please feel free to submit your work back in for a future critique.